right, hello everybody. We're back again for Between Two Fiduciaries. How you doing, Jimmy?
I'm doing great, Jeremy. How are you?
Doing great, doing great. So we're gonna be talking about taxes today and tax adjustments.
Yeah.
And there's a very important one to understand, which is called the tax equivalent yield.
Yeah, we often talk, it's what's more important is what you, not so much what you make, but what you get to keep.
Exactly, exactly. So we'll go through an example here and try to illustrate what this means to people in practical terms. So, if you are a married, filing jointly couple in the state of Michigan, your tax uh, liabilities are the following. And first of all, the assumption here is you're in the top tax bracket.
Right.
Not everybody is in the top tax bracket.
Sure.
This exercise can be run for any of the various tax brackets. This one considers a 37% tax bracket for the federal level.
Right. That makes sense.
And then the state income tax level, it doesn't change. It's 4.25%. That isn't a normal year, actually. Just a side note, in Michigan this year, it's 20 points lower. It's 4.05%.
Right.
So a little bit lower in the year 2023 due to some windfall events.
Right.
And then there's the federal net investment income tax rate. Tell us about that real quick.
Yeah, so that applies to married couples making over $250,000, but essentially this is what was used to fund the healthcare exchange,
Right.
to help subsidize the cost of that.
Got it. So your total tax rate when you're talking about ordinary income events is roughly 45%.
Right, exactly. A lot more than what I think most people are aware of.
It is a lot more. So when you're looking at things like investing in bonds, we know that that's an ordinary income tax liability event.
Correct.
So you're going to have as much as 45% coming off that yield.
Right, exactly. So, I mean, just, quick, easy math. If you have $100 of interest income, as rates have risen here over the past 12 months or so, you make $100 of interest, you got $45 being paid out in tax on that. So you're able to keep roughly $55 of that 100 that you earned.
Absolutely. So now one of the ways in which you can take advantage of some tax sheltering is to look at municipal bonds.
Right.
So let's take a look at that. So this is where we really get into the nuts and bolts of the tax equivalent yield. So if you talk about a municipal bond, these are issued by municipalities, states, to fund various projects that they have, be it infrastructure or otherwise. And they're typically it's just important to note that they're typically very stable from a credit worthiness perspective. Is that right?
Right, exactly. So we've talked about that in some other videos that we've done before, but the municipalities have to do a better job balancing their budget than what the federal government does.
Yeah.
So the credit worthiness tends to be higher, their default rates tend to be lower.
Yep. And they're rated by the various ratings agencies as well, so you can understand that. That is all well published. Municipal bonds are typically going to have a lower interest rate that they're going to provide to those who are become debtors to it, right?
Right.
And so then you get so for instance, in this particular case, the going yield is about 3%.
Right.
And but right, talk us through what you see here on the left-hand side of the screen with the starting with the out-of-state municipals, the U.S. Treasuries, and other debt instruments.
Right. So as you pointed out, the municipal bonds typically offer a lower interest rate than what corporate bond issuers or even what the U.S. government offers, because the municipal bond, the interest income coming from those municipal bonds is tax-free at the federal level.
Right.
And if you are a resident of the state where that municipality issued the bond, if you're a resident of that state, it's also state income tax free as well. So you now have skirted both the federal and state tax levels for that interest income being earned. So the number that jumps out at me when I'm looking at the left side of the chart here is, I think people are typically used to, most notably, corporate bonds or municipal bonds.
Mm-hmm.
When you look at ETFs and mutual funds, these are the most commonly composed investment products from a debt perspective. And when you look at the bottom left there, the other debt investments, those are corporate bonds. So what you're looking at here is you need to get almost 5.5% of interest out of a corporate bond to have the same tax equivalent yield as what you'd get from a 3% municipal bond issued in the state of Michigan.
Yeah.
So when you're then, again, we're using the state of Michigan resident, married couple filing jointly, but they literally need to earn almost, 5.5%. It's almost 100% more in the interest rate when you take 3% compared to 5.5%. You're talking about an almost 100%. You need to almost double the coupon interest payment from a corporate bond to match the same tax equivalent yield.
Right. So 3% is not really 3%.
That's exactly right.
So it is one of the sort of the puzzle pieces that we're trying to explain here around the bond market. And is it possible to get a corporate bond at 5.5%? It is. You typically have to go down the credit worthiness scale a little bit.
Right.
And then
now you're having a conversation of risk versus return, right? How much more risk, when you're moving down that credit structure and you're getting into bonds that are less secure from a repayment perspective, how much yield do you need to get to justify the additional level of risk that you're taking? As we mentioned before, these municipal bonds tend to have a higher level of credit worthiness as opposed to some of the, high yield or junk bond debt issuers.
Yep. And last point we'll kind of try to reiterate here is that municipal bonds are not for everybody.
Sure.
Right? They're number one, they are for people who typically have a higher income.
And for people who have money outside of their retirement accounts, right?
Right.
Like a municipal bond doesn't make sense to own in a tax deferred IRA or 401k because you're the tax deferral.
Correct.
But for those who have investments outside of their retirement accounts, typically we see retirees wanting to have more of an allocation to fixed income to balance out the volatility in the portfolio. If you do have money that's invested in a non-retirement account, municipal bonds definitely can and should probably play a greater role in your portfolio. So really important to understand, what does 3% really mean?
Totally. Well said. And so remember, tax equivalent yield, it's important to understand. These are the inside math numbers that you need to know in order to make good decisions. So that's really all we have today. Thanks so much for being with us once again.